Hey guys, hope all is well. Today I want to share with you a very powerful strategy, a powerful concept that we've been working on for quite some time. It's not rocket science and has been quite successful for me. So we'll talk about the foundation of the strategy. We'll then talk about the detailed trade plan, followed by what are the mechanical entry models, the theory behind the entry models, and then also look at a number of examples that we have taken both from backtesting, forward testing, some live examples to really illustrate how successful or how common sense driven this strategy is. So let's get to it. So for me, when I look at a strategy, and I've done it all, right? So I've been the retail side, I've done the SMC, I've done the news trend, I've done the ICT type of trading, not for long, but I dabbled into that, Wyckoff, trade signals. And the problem with all of them, or at least to me, is that a good strategy has to be simple and repeatable. The reason why is because you're not taking your trading as a casino, right? You are building a business that you can execute your business for the next 10, 20 years. And in order to do that for the next 10, 20 years, you need to have a very relatable, a very simple mechanical approach to the market that if you see a couple of things, A plus B equals C, you execute. And if there is any one of those elements not there, you just simply walk by, right? So for me, it has to be repeatable. It has to be consistent. I should be able to do this for the next 10, 20, 30 years without having the whole element of mental torture. I value my mental health quite a bit. So I don't want that stress associated with it. And the reason why we would not have that because we 100% believe in what I'm executing. Now, there are a million ways that you can make $1 million in the market. We all see the same chart, right? But every one of us interprets that chart differently. We all will come up with different narratives that fit our worldview of what the chart is telling us, and then we will execute based on that, based on our reasoning, based on our past experiences on these things have brought me success. And if that happens and I'm in the right frame of mind and I feel the same, my emotions kick in, I'm going to execute and we'll leave it rest on how the strategy plays out. Now, there's something called as Pareidolia, right? It's a condition. Obviously, Pareidolia is an extreme form of what we all have, is basically a tendency for pattern recognition. But Pareidolia is the extreme form of it. So by definition, and I'm just going to read this off of the dictionary, it says here, pareidolia is the tendency for perception to impose a meaningful interpretation on a nebulous stimulus, usually visual, so that one detects an object, pattern, or meaning where there is none. And I believe this statement holds very true with a lot of how we have been trading. So for example, pattern recognition. I can look at a chart and I can give you a narrative on pattern recognitions. And based on your experiences and your history, this pattern has brought you a lot of success. You will execute. Now, keeping success a bit on the side, does that pattern in itself the reason why the market is moving? No, right? You can argue with me back and forth, but for me, absolutely not. You can argue that because millions and millions of people follow that same pattern, so collectively it does have an impact on the market, but essentially is that pattern the reason the market is moving? None. I can give you an example where my strategy involves at London Open, I hop on one leg and I'm going to take a short. Now that short in reality is 50%. Either I'll win or I'll lose. But in my mind, I've said that by jumping on that one leg, I have increased 1% chance in my favor. So the odds are now 51 and 49. Now, over a long period of time, maybe that might work, maybe that not work. Maybe you will have the placebo effect. Maybe the conditions of the market sways in your direction, but over 10, 20 years, will you be able to repeat success? That is the question. And the other thing is that what this strategy does, or what I'm trying to do today, is that I'm trying to teach you a skill set. You can take what fits you well. You can take what you understand and resonate with and leave the rest and make something completely new out of what I'm sharing. But the idea is that we should all have the skill set on how do we read the market? How do you interpret what's going on multiple time frames? What is happening in the candles? How do you execute a trade? Because that skill set, nobody can take away from you. That is something that inherently you have developed, you have learned, you have honed in that craft and will be with you forever. So irrespective of if you have a job that is paying you well right now, or you are fallen on hardships, or you want to try something on the side, that skill set stays with you forever. Now, being part of these Telegram signals and signal providers, just follow me, a copy trader, why be dependent on somebody else, right? Their upbringing, their mindset is completely different to yours. Why would you want to put yourself just blindly following the other in hopes of making money and not believe and trust in yourself or the work that you put in, right? So that is where this strategy has stemmed from. It is a combination of a number of things that I've learned over the years. And let's go and dive a little deeper into what this is. Now, I wanted to keep the strategy very, very simple. And like I've said before, I want to treat this as a business and encourage every one of you treat this as a business so that you can do it repeatably and consistently for over a period of 10, 20 years in the future. One thing that nobody can argue, no matter which school of thought you subscribe to, opening day candle, opening range breakout, London Open, New York Open, whatever have you, SMC topics, ICT, whatever have you, whichever school of thought that you belong to, nobody can argue that a market has two phases. There's a consolidation phase, and then there is an expansion phase, right? The market trends, and the market sort of consolidates. Now, all of these elements, these two elements, everybody is running after. We want to make money while the market is trending. You can make money while it consolidates. There are different ways to go about doing it. But the easiest way is follow the trend. And what does following the trend mean? Following the trend means that you want to get into the market early enough after it has given you proof that it is going to start trending now, and then you just ride the trend, and depending on your trade management, you execute that to a T. So let's look at the graph now. If you follow the dark blue line, which is right here, this is clearly a trend. Yes, you have your lower highs, higher highs, higher lows, higher high, higher lows, and then suddenly you have a change of character over here, and then obviously you have lower highs, lower lows, lower highs, lower lows, all the way down, and then you have a pullback phase, right? And then you have another push phase where you have the trend complete. Now, I also showed you these two 15-minute candles that are in light red and a little bit darker red at the back end. And what I'm trying to illustrate is that an entire candle that you see here, the 15-minute candle, has trends within it, right? There's an entire 1 minute trend that is happening within that 15-minute candle. So if the question becomes that I want to ride the trend, why do I have to look at any further than just these two candles, right? Why can I not then take advantage of the first candle, which is showing me on the 1 minute it is trending, and with logic, I want to capture the trend, assuming that the trend will continue, then why can I not take advantage of the next 15-minute candle, hoping that it will continue the trend with the market on my side, and take advantage of early entries using the lower time frames? Why do I have to wait an entire session or days for price to move back to a certain order block? Or why do I have to wait for the price to break certain key level in the market, a strong high, a strong low? Why not just look at each 15-minute candle or a 1 hour candle and get an opportunity to trade for the entire session that you're trading? Now, obviously, I trade London because my time suits well and there's more volatility. I have more success in London, but the same thing goes with New York. You trade the first 3 hours of that session and you have that many 15-minute candles. you should have plenty of opportunities if a trend develops to catch that trend on every 15-minute candle, right? And if you're not aiming for the moon with 20, 30, 15, 10 hours, you could very consistently uh, make 2 hours, 3 hours, or even 4 hours and compound that profit day in, day out on both sessions, looking at multiple pairs. EU, GU are prime examples, and they work very well with the strategy. I myself haven't tested any other pair, but I can guarantee you that the market moves in certain fashions. For example, it trends and it consolidates. And if it's trending, the candles will tell you it's trending. It's visually there. All you have to do is recognize it on a smaller time frame, recognize where do you want to enter, put some rules around those entries, and enter. Simple as that. I don't want to be waiting for the price to reach at a certain level, price to start sweeping things around, price to hunt for liquidity. All of those concepts are there and they're part of the strategy as well. But all I'm saying is that you will have many more opportunities, high quality opportunities in trend following, not waiting for price to reach a certain order block on a larger time frame, but just looking at every 15-minute candle and trying to capitalize the smaller time frame trend within it. So let's follow here and let's go in depth. This 1 minute time frame, obviously you can see is the trend, right? Now, when these trends are forming, they are giving you information. They are leaving behind footprints, which will be useful to you when you try to take advantage of them in the next 15-minute candle. There is a wick creation over here. So this change of character, when that happens, obviously the price moves up and the price moves down. Just this part right now is the creation of the wick. Price is then moving downwards, and all it is doing is it's either sweeping strong highs, creating sweep zones, it's coming down, it's creating supply and demand zones, it's going further down, it goes up, goes down, and then also retraces itself towards the end of the candle. And that last minute retracement, it creates the bottom wick of that candle, right? And then it happily goes on upwards until it reaches some sort of a supply and some sort of a demand supply zone. Now, our objective is, and we will go in depth on the entry models and what's going on here. Our objective is that I can see visually there is a downward trend. Now, how do I capitalize this? As price is moving back into these zones, not on some 4 hour or 1 hour or 15-minute order block that'll take hours and hours or my entire session to get to, and then I hope that the lower time frame will show me a confirmation, and otherwise the entire session is gone. But I get these opportunities literally on every other 15-minute candle for that entire 3-hour period. So once your 15-minute candle is finished, it closes here, your next 15-minute candle is printing. You are now looking at what the 1 minute time frame is doing. The 1 minute time frame has told you that there is a demand zone, there is a zone here, supply and demand zone here, and then there is a supply and demand zone over here. Now you wait for price to go up to one of these zones and wait for a confirmation. Confirmation is what? A simple chalk on 1 minute time frame. Maybe you don't get a chalk on this right here, yeah? And price keeps pushing and breaks this zone, and the zone is now gone. It goes to the next zone. This seems a little stronger because it swept a strong high and then immediately created a lower low. So I'm thinking this zone will hold with the hope of the trend will continue downwards, because on the swing line, what is it showing us? This is the higher low. So this is the higher low. This is the lower low. This is the higher low. And now we are expecting this low to go, because this low failed to break this high. If it failed to break this high, it is giving you evidence now it's changing character. I want to enter at this point, anticipating that the price will continue following the trend until the next 15 minutes will be bearish. You can enter directly on the liquidation candle, and we'll talk about what liquidation is when we go into the theory of the entry models. But very quickly, a liquidation is something which gets run, a strong high, a strong low gets run, and then immediately creates a chalk. So for example, this high broke this low, so this is a strong high. We expect this high to maintain itself and not get broken. But if this high gets broken, liquidity behind this, all the stop orders over here, are being taken, and then price goes into this supply demand zone. If this liquidity was enough for, and the supply, the orders in here was enough for the price to react in a way that it creates a shock, I want to enter, because those are two strong signals that the price may now continue moving downwards. But in this case, there was no entry, there was no chalk, so you don't enter, and price keeps moving forward. Once it reaches the next supply zone, and this is a little higher, because stronger, because it is a sweep zone as well, you took liquidity over here, right? Because this is a strong high that broke the low, so this should maintain itself. It took liquidity, went into a supply demand zone, and immediately created an order flow chain. Once that order flow chain happens, either you can enter directly on the liquidation candle, or you wait on the 1 minute time frame for order flow shift to happen, that you confirm that the order flow shift has happened, and then you enter at the low over here, right? Gives you a little extra bonus of confirmation that the price is now trending downwards. And when obviously the price trend downwards, the wick starts getting created, and once the wick is done and you pass the previous candle body close, the body starts forming in, and the anticipation is the price could go down. Now obviously the price can come up, go down, come up, go down. It can stop you out. A lot of scenarios can happen once you enter, but this entire setup gives me strong edge in the market that happens repeatable and consistently in the market, that I can take advantage of. Open any time frame, open any chart, look at London Open, look at New York Open, and tell me, is the market just creating consolidations all the time? Or do you see trends happen? There is order flow shift, and then you could have easily entered, taking advantage of those lower time frame entries, which is on the wick of the next 15-minute candle, and ride that one candle. I'm not interested in the market to be in there for hours. I'm not a swing trader, Dre, and I am a session trader. I want my trades to end within 15 minutes to max 30 minutes, 2 candles after I enter the trade. Majority of my trades, I'm in, I'm out in a number of minutes, and I want to limit my exposure while I'm in the market. I'm more happy on the sidelines, enter when I see things are going in the direction that I want them to go. There's proof for me to execute, I enter, and then I leave. Yeah. So let's look at how would you execute this, and then we'll go into the mechanical entry models, and after that we will see a number of examples where I show you the power of just following the internal 1 minute trend, capturing it using the 15-minute medium time frame. So the higher time frames, we look at the higher time frame, which is daily, and I look at that just to give me a very mile high view on what the market is doing. Is it under consolidation? Was there a breakout from yesterday's high or yesterday's low? So I'm anticipating the market to continue in that direction. But it's just really high. I'm not building any bias. It just gives me some background information on what the market may or may not do the day I'm trading. This is where things get important. The medium time frame is your bread and butter time frame, right? So in my case, I use the M15. You could use the 1H. You can use the 30-minute time frame, but this gives me the immediate bias, where I want to look, or where the market is trending for the next 15 minutes, right? And then lower time frame is strictly for execution. You're not building any narration on the lower time frame. You're using that strictly for execution. If you're using the M15 as your medium time frame, I would advise use M1 as your execution time frame, because there are plenty of candles that can form within that 15 1-minute candles to help you get into a nice mechanical entry. For 1H, I would advise use the 5-minute entry time frame, and for M30, maybe you want to use the 2-minute entry time frame. Obviously, execution happens when you get that mechanical setup, and you never use the lower time frame as a narrative building time frame. You use that as you use medium time frame for that. So what is the narrative, right? How do I select which candle do I want to trade from? So technically, you can select every 15-minute candle, but that is not a high probability trading. You want to select those candles that are trending and that have a very clear, visible 1-minute trend on them, and then those candles that have a clear shift in order flow, right? So, what is the kind of objective of the candle? Is it sweeping? Is it going in the trend? What is has there been an order flow change in that 15-minute candle? By that, what I mean is that this wick here, the body and the lower wick, we know is a trend inside it, right? So if this breaks, right, there is an order flow shift that is happening if towards the down, so the trend is continuing. But in this case, let's assume the next is a bullish candle, right? And it breaks this wick, and we have a body here like that. This wick gets broken by that body. What have we done? On the lower time frame, this was a strong swing high for 1 minute, which has now been broken by the body. So now I know that the lower time 1 minute bearish trend has changed into bullish trend, and this 15-minute bullish candle tells me that. So now what am I doing? I am anticipating the next 15-minute candle to be bullish, expecting that there would be some pullback on the 1 minute time frame or the lower execution time frame into a zone or supply and demand zone, or it gives me a mechanical entry, which I can then take advantage for the next 15-minute candle to go in the direction which is bullish. Did the Asian session get swept and had immediate order flow? Now, this is a very powerful 15-minute candle. So what happens is that you have the Asian session. Let's say this box is the Asian session. You will have a candle that will sweep the high, right? It will not close above, but the very next candle would be bearish candle, and it will close below the wick of the previous candle, which clearly tells me that all of that liquidity has been taken. There is an immediate order flow, and chances are that this particular candle has a very strong trend in it, and I want to capture that trend for the next 15-minute candle also to be bearish. Now, keep in mind that not every 15-minute candle is going to create a trend. You will have many that will be inside bars. You will have bullish, bearish candles that will have no significant movement. Those are candles you want to avoid. And the reason and the way how we avoid them is to ask yourself these questions. Is the momentum king again at London or New York? Right? Every candle has a range. Now, if you are looking at the Asian time frame, you're looking at pre-London open, and the candles are what yay high candles, like so 5 pip, 10 pip candle, and suddenly you have a big candle. I say that big money has stepped in. I say momentum is kicking in. I say a lot of orders have come into that candle. I say that was an order flow shift that happened in that candle, and I want to take advantage of it when it comes back into some level of supply demand and shows me that change. I want to take advantage of it. So the range of the candle, the momentum will clearly tell you. You will see it when that happens. That momentum is now coming in. Now, is it a strong close or with a wick rejection? So you will see many candles that will come in, very strong, but last 5 seconds or so, the price will start pushing back, and there will be a massive wick left. Now, do you really want to use that as your basis candle for trend building? Because that last wick moving upwards, this last leg here of the same candle, right? This wick, this price moving upward happens earlier on. So you can imagine the price is going down like this, and then suddenly it retraces back in the same candle, and then you have that large wick left. I wouldn't use that candle to tell me that the trend is following, right? There is a huge pushback that is already happening, a wick rejection. You want to see candles that are going in the direction that you want to trade and are also with a strong body close and not with wick rejections. And then lastly are 2 or more 15-minute candles in consolidation. What that means is that this 15-minute candle is somewhere here, just right there, and then you have another bullish candle coming up in that same range. So essentially, they're not able to break the high, they're not able to break the low. There are multiple sweeps that are happening on both sides. Stay out of the market. You will get butchered to death in that scenario. Wait for clear price breakout. use that as your main first candle, or wait even further, maybe the breakout is fake and then you have another candle that gives you that order flow change, and you move into the very next candle after that, right? So stay out of consolidations. I would never advise anybody to trade within the consolidation range. Okay, guys, so now you know the whole philosophy of what my strategy is. It's a very simple, repeatable, consistent strategy, mechanical strategy that I follow, with some very strict rules that have to be met before I get into a trade. The overall strategy works quite well. It's a trend following strategy, but it takes all the noise out of it. You are just focused on one session, and you're focused on a handful of 15-minute candles trying to take advantage of that lower time frame entry. So on the lower time frame right now, I have 4 mechanical entry models that I will explain to you in detail. And then after this, we will go into some real life examples. So my number 1 entry model, and this is my money setup, is basically EM1, where you have a liquidation reaction from a supply and demand zone. What does that mean? Is that as price is pulling back, which is the wick creation of the second 1 hour, 15 minute, whichever medium time frame you use, is pulling back, it has taken some level or broken some level of a strong high, right? The reason why this is a strong high is because it has broken a low, which creates this a strong high, because the anticipation is that this high stays intact. If this high changes, then we have an order flow change, and then possibly the trend is changing as well, right? But in this case, if it's capturing that liquidity, goes into a valid zone, either you can enter on the reaction candle. You will see on the 1 minute a complete opposite reaction, which gives you an order flow change, and enter stop order on the breakout of the next candle on 1 minute. Or you can place an entry right there, which is this would be the liquidation candle. So you place an entry, stop order right there, with the stop placed above that, right? Typically, I don't cover the entire zone because this increases the stop loss range. But if my analysis is correct, this should never break, right? Because this becomes a strong high, which has taken the strong low, and then you enter anticipating that this medium time frame trend continues with a pullback and then continues downwards. Yeah. So this is my money trade, money setup: liquidation, valid zone, reaction, enter. Now this is my B setup, or A minus, because there's no liquidation that happens here. So what happens is that as candles are forming here, there is no pullback in the first 15-minute candle. Each candle is breaking the low of the previous candle's wick and respecting the highs of the wicks, right? So if I were to show you back on this chart, all of these highs are being maintained, and then another fall, and all of these the low wicks are being broken, right? So if that happens, there is no strong liquidity in this leg. And if the price is pulling back, it goes into a valid zone. I would never then place on the liquidation candle because there is none. I would wait for the market to show me a strong reaction, and you will know when it is a strong reaction. The range of the candle will be bigger. It'll be a strong, immediate, direct move in the opposite direction. You will break the low. The OFC will change the strong low, and I would put a stop order and enter right there. Yeah. So these two setups are my bread and butter. The shallow breakout entry model 3, this happens quite often, but I don't typically take this. I take this when I'm convinced that the first 15-minute candle has very strong momentum coming in, price is moving quite aggressively. The candle itself maybe had a sweep on the medium time frame and then had an immediate order flow change. So there are many things that I look at if I want to trade this really shallow pullback. So what happens is in this instance is, instead of the pullback happening to a 30%, 50%, or even higher mark of the previous 15-minute candle, it probably does so up to 10%. right? So there would be a valid zone there for sure. And if the lower time frame is moving up, gives you an order flow change. So instead of entering at the reaction candle, so this reaction candle could be even higher, but still a strong momentum, I would put a breakout entry right at the close of the previous candle's body, right? So that as soon as it breaks and a new body is created, so this would be the wick. As soon as the new body is created, you are already in the trend. But the challenge with this is that as it breaks with such a small wick, and sometimes even no wick, what happens is that there might be tendency for it to go back, stop you out, go deeper, find some high probability POIs higher up, and then go in that direction. So many times you get faked out on this one unless you know what you're looking for and there is clear momentum in the market and price is moving very, very aggressively. And the last one is liquidation of the equals. So let's say on the pullback phase, right? All of these liquidations can also happen on the pullback phase. So for example, if price is going down, moving up, goes down, breaks this low, and then breaks this high. So this high became strong because if price broke this low, which was supposed to be strong, breaks this low, and then immediately breaks this high again. So that's a liquidation that have happened in the pullback phase. This is a liquidation that has happened on the initial 15-minute candle, right? Now, in this case, what's happening is it's a pullback phase and price is created sort of equals, and then suddenly it sweeps that and closes aggressively below this. Then that is where I enter. Typically, I don't see this a lot. Of times, I don't enter on this model at all. It is there. If you like it and create an edge on it, and if you can recognize the pattern of equals. But the question becomes, what is an equal, right? There is no mechanical rule that I can create in defining what an equal is. It will be eyeballing, and for me, that is subjective. So I want to keep things very, very systematic, very mechanical. If A happens, then B. If B happens, then C. If B does not happen, I'm not going to C. Simple as that. Keeps my sanity in check. Now, the liquidations, as I mentioned earlier, over here, so there's no liquidation here. The liquidation that happens here could happen in the previous 15-minute candle or also in the pullback phase, and both liquidations are valid, provided that you're going into a valid zone and then you see a reaction from that zone. Okay. Okay, so if you've reached this far, congratulations, because you have definitely improved your understanding of the market ever so slightly. And now we're going to be talking in depth about the entry models. So in previous session, we looked at the logic behind those entry models, right? The theory behind it. And now we're looking at real trades that I've taken, and I've taken a snapshot of those trades to explain what that entry model looks like on the charts. So the first one, EM1, entry model number 1, which is the liquidation reaction from supply and demand zone. What this is you have to have a clear trend in the direction of the trade, a liquidation of a strong high or a low during the pullback or during the previous candle, pullback to a valid supply and demand zone. So you have a pullback, clear reaction from the supply and demand zone, breaking the microstructure. So basically an order flow change, enter at the breakout of the reaction candle or enter directly on the liquidation candle, and stop loss behind the reaction candle or liquidation candle. So all of these steps must happen for me to enter. And I will go one by one on each one of these entries. Now, the first thing I want to ask is, or at least I want to tell you is, this box that you see over here, this red box which has a very light opacity that you see here is what? The way I trade is that the candle that I'm interested in, I will just put a red box around that candle, and then I will put the red box around the next candle. So the next candle is printing, right, and telling me what's going on for me to take an trade. The reason I put this red box is that in my mind, it isolates the region that I'm focusing on, because focus is very, very important. I put this box, everything else on the chart becomes irrelevant because I've identified the candle that I want to trade, and I'm only focused on price action within that red box, what is happening. And if my entry criteria is met, I take an entry, right? You can use it, not use it. You think it's probably, maybe it's childish, you don't want to do this. But for me, it helps me to focus inside that box for the 15 minutes or 1 second candle, 15 minute, to see what price is doing within that box. As soon as price, that second 15-minute candle closes, I delete that box because I'm not longer focusing on it, and then I focus on the next 15-minute candle. The other thing that I want to share with you is that each box over here, what do you see? There is a clear trend in each one of these boxes, right? So the red box basically is 2 15-minute candles, right? And the candles printed within it is the 1 minute trend. So you can see clear trend to the upside. This is consolidation, and I will explain why I took this trade. And I did not capture what is happening on this side, but there was a clear trend downwards. This was the pullback, and then there is a clear trend downwards. Clear trending market downwards, right? This is the first 15-minute candle. Clear trending market downwards. Again, this is the first 15-minute candle. Clear 1 minute trend downwards. And again, this is the first 15-minute candle. Every candle, while creating that 1 minute trend, has given us information. Let's look at this. There is a clear supply zone. As price is moving backwards, it took this liquidity. This liquidity, this is a strong high because it broke this low, right? So once this is taken, price has gone into an area that I'm interested in, my POI. I placed an entry, a stop order entry on the liquidation cancel, the candle that took this. Now you could argue that the liquidity was taken over here. If I had placed a trade over here as such, there was no entry. If there's no entry, it broke the high, I simply delete my trade and move it up to the next candle. And if it breaks the low over here, I'm in the trade. And that's what happens. I'm in the trade. Next one. The price is clearly trending downwards. It pushed up and went downwards. I believe the half mark is the next 15-minute wick creation. So this pullback is the wick creation. It took this high, which was strong liquidity because this high broke this low. It took this high, went into a proper zone that I was interested in, gave me a reaction. I took it at the breakout of this, and the price went down. Yes. If this had gone, if the price moved upwards and gave me no entry and the price moved upwards, I would have viewed this as a strong liquidation and wait for the price to reach at this point. After that, there is really no interest or POIs for me to trade from. So this or this would have worked. Now, very easily, price could have just tagged me in and gone in the opposite direction. So be it. I cannot have 100% win rate. Nobody can have 100% win rate. All we are doing is that we have a slightly greater edge than tossing a coin, which is 50%. And this, the way I trade or I'm presenting this to you, greatly increases my edge in the market. Let's look at this trade. The pattern, also, sorry, the trend that is happening over here, which I've not shown, is clearly in the downward direction, right? Price went up. This becomes a strong high in the previous 15-minute candle because it breaks this low. Price is now moving up. As it moves up, it takes this liquidity, and I place my stop order at the bottom wick of this liquidation candle. The price could have easily gone higher. I would have just simply moved my entry to that candle's bottom wick, and the price could have easily broken this. If the price had broken the top of this range, I would have deleted my order, waited for this 15-minute candle to close, because look at this, a beautiful trend in itself. So now I could wait for the next 15-minute candle over here to start printing. The price could start moving up, creating a wick of the third 15-minute candle, and I look for zones, right? And these wicks, right? So these wick exchanges, supply to demand wicks, I normally view them as POI. So if price goes into this little area here, this wick zone over here, and it gave me a reaction, I will enter, because that still gives me enough of an edge that over a large sample size, I will be profitable, right? So now look at this. Clearly a good trend downwards. price moves up and moves aggressively down, a high probability POI, because this candle even took the high of the previous candle. So very, very nicely, a high probability POI. Price is pushed down, and on the way up, look what it does. It takes this high, which broke this low with the candle body closure. Liquidation has happened, but I did not place my entry over here with a stop loss over there. And the reason why is because it did not mitigate my POI. So for me, the number one rule that has to happen irrespective of liquidation, it has to mitigate the POI that I'm interested in. If it does not, I do not take the trade. So the very next candle, not giving me an entry, goes into my POI, gives me a strong close. I then enter as a stop order on the wick or the body breakout of the next, and then gives me a nice reaction. Now, I also wanted to show you not every trade is a winner. In this, I had a nice reaction, but it did not hit my first take profit. It turned around on me and did a break even. So by the time price was here, I was already break even, right? So it wasn't a loss. Now imagine if price continued upwards and took this POI out. I simply delete this red box. This becomes the strong liquidation for me, and then I wait for the price to reach this POI. So if the liquidation happens, it takes this high and then immediately gives me an order flow change. I am not as interested, even though it's one of my last entry models. For me, those are low probabilities. I would rather it mitigate a POI with a liquidation or a POI without a liquidation, showing me a reaction for me to enter. And this is a perfect example of that, right? So do you see a trend? No. It is a consolidated market. So the first 15 minutes is not going anywhere. It's just chopping around. Not a clear, healthy trend like any one of these that you see over here, right? So it is prices going up, going down, going up, came all the way down. And then we had a liquidation over here. The reason I took this liquidation trade is I did not place my stop order over here because there was no high probability POI. There is no POI. Everything is mitigated. So the probability of me taking a trade over here, going in and going out, was very high. But the reason why I took this trade is that after the liquidation happened, immediately after that, look at that momentum shift coming in. Look at that strong close. There's no wick. There's no wick rejection. Look at that, right? It took all its liquidity. It took this immediate price movement. I said, this is enough for me. Entered a stop order over here. Price came back in and it shot to the moon, right? This is another example, my last example over here. A beautiful example. Look at this. Clear trend to the upside, right? Price moves down and then moves up. This strong low was taken, so this becomes a sweep zone. So this right here becomes a sweep zone. In fact, it also took out this strong low. It becomes a sweep zone demand. Price then starts to fall back on the next 15-minute candle. While it is falling back, it took this liquidity because price went high, it went low, it went high again and broke this strong low. Price is coming down, coming down, coming down, coming down. And then instead of me taking the breakout of the liquidation candle, I waited for a little bit of an extra confirmation to show that there was an OFC change on the 1 minute time frame, which is this wick being broken by the bullish candle, and I entered a stop order with that strong momentum, no wick to the upside, body close for it to take me to the upside. I did not, even though this was a liquidation, for me, this was not a very strong liquidation like this or something like this. Yes, it's an inside bar. It is a low that was created, which broke the high. But if this strong reaction did not happen and price kept tanking, I would probably not place my entry at the liquidation candle. And the reason for that is that I would probably expect it to tag me in and then go the opposite direction and stop me out. So I waited for the reaction. It did come out really close, but then it shot in my direction. Okay. Alrighty, guys. So now we enter into the second entry model, EM2. I should have changed that from EM1 to EM2, but basically what this is a reaction from a supply and demand zone. Everything stays the same. There is no liquidation in this card, but you wait for a reaction from a valid zone. First question first, what do you see? Every one of those big red boxes shows a trend that is happening on the lower time frame. That is very important. Once price starts pulling backwards, I want to see a strong reaction from a valid zone. And then you enter stop order at the edge of that candle and hoping, anticipation that the price will continue in the trend that was evident in the previous 15-minute or 1-hour candle. That was the first trade. My second trade, there was a clear zone that I was interested in. Price pulled back and it gave me a reaction which broke this low, a clear OFC. And I entered this trade and it took me straight for a winner. My third example was this was consolidation. There is no range that is happening in. So price moved up, moved down. It went into a clear supply zone and it gave me a reaction. Now, one of the reasons why I probably took this is because on the 15-minute time frame, the previous candle was definitely bearish, but it was bearish in a way that it probably created an order flow shift, or it swept some sort of a high probability or a strong liquidity zone and closed bearish. So for me, even though sometimes the trade is not clearly visible, but on the medium time frame, a little higher view, it was showing the intent, the market was showing the intent that it will continue downwards. Anyway, so the price clearly moved up, no liquidation. I cannot put an entry on the edge of this candle, which would be the breakout of the liquidation candle, because no liquidity was swept. And once I have that reaction, I enter and then I take the trade. Let's look at this one. Clear direction to the upside. There was an order flow change on this candle, which is why you see a consolidation. It created a sweep zone demand. So it took the low high and then immediately broke the highs over here. And then with the next 15-minute candle, it started coming back into that same high probability POI because it swept this low. And it gave me a strong reaction. If you notice, all my reactions have no wicks to the top side or the side that I want to trade in. They are strong body closes. Once that happens, I'm interested. I entered a stop order, placing my stop loss behind the candle itself, or I could have gone here. But the way the intent of the chart, medium time frame, was strong enough that I said, this is enough, and look at it fly. Let's look at this trade here. Now, in this trade, again, there was no liquidation, right? So price was moving backwards. There is no strong liquidation to be had or any that was evident to me, right? So this low did not break any high. The rest of the guys respected their strong lows, but this was the zone that I was interested in. It came into that zone and had a strong reaction. But if you notice very carefully, I did not place a stop order on this reaction candle at all. What I wanted to see was the high, the wick high of the previous candle to break, because that will then indicate an OFC happened. So if the price is going to move in the direction that I wanted to move, this high needs to break. So if that is why you see a gap over here, and I placed an order on the wick of this candle, so that as you get entered, you're already having an OFC and that momentum will push you higher before it comes down. Same thing here. And this is the case where, you know, you have the 15-minute candle and the wick of the next 15-minute candle came all the way to the origin, all the way to the 75-80% mark of the first 15-minute candle body. And that is when even to the wick, and that is when you have a high probability POI, which is a sweep zone. It comes into this, but there was no strong liquidation. There was no liquidity that I could have had. So I did not place a trade on the breakout of this high. And because this is not a liquidation candle, the next candle was an inside bar. So I was waiting for a reaction, and that's when I got the reaction that it closed above this high with a strong body close, which means that if I put all of these candles together, it was a strong reaction from this. This was the evidence that I got, placed a stop order on the top of this candle with my stop loss behind the inside bar. And that took me in for a win. My last trade over here, clearly a straight push. Now, typically in the Forex markets or on the charts, when you see a massive straight push like that, there are market manipulations, maybe a news event that have happened or some chair spoke on interest rates. But when that happens, price immediately retraces it back, or more often than not, even breaks the direction of this candle. So it could have easily taken this low out, which means that my entire trade idea would have been invalidated. But in this case, I don't enter based on my gut feel. I enter based on evidence that the market is showing me. What happens? The price comes into the zone. This is the last extreme zone that I'm hoping that it will hold. It was a bullish candle, started to trace back, gave me evidence, not strong evidence. It did break this bearish candle, bear close, did not have a wick on the top, so it did give me a reaction, but I was not interested in entering on this breakout of this because there was no wick. I entered at the top of that wick. So if this high breaks, that means that order flow has happened and I'm in the trade itself. But I did not place it at the body of this candle. So it was the next candle, wick top, in anticipation that if I get tagged in, the order flow would have changed and then I would have been in the entry. Okay, so overall, this EM2 has reactions from a solid point of interest, which is on the 1 minute time frame, being encapsulated by the higher medium time frame 15-minute candle. Okay. And my last entry model, the shallow breakout. And then I have some miscellaneous entries that I'll show to you after this, but those are the ones that I typically never take, or take if there is very, very strong conviction in the market. And even the shallow breakouts, I don't take it unless the medium time frame narrative is very, very strong and the evidence on the lower time frame is even stronger, right? So shallow breakout, instead of, let's go into the first example. This red box over here, very clearly, these are, if you draw a line right in the middle, this is the first 15-minute candle, this is the second 15-minute candle, right? You had a clear trend to the upside on the first 15-minute candle, and then it pulled back, and the second 15-minute candle basically had a pullback, a very shallow wick created with this pullback, and then it closed strong. Now that close was in itself not enough for me to enter, so I said there is a strong push. It mitigated clearly this wick exchange, which is buyers and sellers having an exchange, and then buyers winning, right? Sell to buy wicks, and it had clearly mitigated that, and it closed bullish. Still not enough for me, or convincing enough for me to enter the trade, but I know the trade is going to continue. So I entered on the breakout of this high, keeping my stop loss behind this, right? Because this candle over here swept everything, all this liquidity on this trend line, micro trend line, swept all that liquidity and had a strong reaction closing bullish. Was enough for me to enter the trade at the breakout of the high, which means a clear OFC has happened. So the price did push up. Obviously, you have to have a pullback. This is where the pullback was, and then the price shot upwards towards my target, right? A very shallow pullback, creating the next 15-minute candle. The same thing over here. If I had shown you price, the price was clearly in the uptrend. It had created a demand zone, right? SO, which is also a sweep zone. Yes, because sweeps are in the sense that this was a strong low, which broke this high, so the liquidity was taken, and after the zone was created, it had a strong push. Now, I did not enter at this point because we were still in the previous 15-minute close, so the new candle has not started printing. Otherwise, if this was the case with the new candle printed, I would have entered at the breakout of this. But the new candle had not printed, so when the new candle started printing, it printed this candle, went back into this zone over here, the POI, and then had a strong bullish close, and then I entered at the breakout of the body, right? So the wick was just this much, and that's when the body came in and the price shot up in heavy momentum. Same thing with this movement upwards, bullish trend, comes back and pulls back out, creates a clear demand zone. Price then pulls back into the demand zone, so everything is very tight price movement, right? So there's no space between the demand zone. It did not go up and then come back into the demand zone, which I would have preferred. but price went out and immediately came back in, and then gave me an inside bar, closed up higher. So I said, fine, if the price breaks out of this high of the body, I will put a stop loss. Price did tag me in with a breakout, which is also an OFC, and then it pushed towards the high. Now, these are winners that I'm showing you, which have happened in real life. You could easily go high and then come back, stop you out, maybe mitigate this. This would be the liquidation, strong liquidation, come back into this demand zone, and then enter on the liquidation candle on the reaction candle. That could have easily have happened, which is why for me, EM3, the shallow breakouts have a very risk inherent in it, because you don't know when the price is going to go against you very quickly, because the wick hasn't mitigated even the 50% of the previous candle's body, which is important for sustained, consistent trend to follow. And I've seen cases where price has stopped me out, and then gone in the same direction eventually, but mitigated something deeper in the previous 15-minute candle. My last example, downward trend goes up, creates a supply zone, price moves out, so it's not as tight, price moves back in again, gives me a strong reaction. Now, if this price action was somewhere over here, right, where at least 50%, between 40 and 60% of the previous candle's body was mitigated, if this price action was somewhere up here, I would have taken the trade at the breakout of this bearish candle with stop loss over here. But for me, because it was such a shallow pullback, there is momentum coming in. I placed a stop order at the low, which is the body creation. So this is the wick now. As soon as the body is created, the anticipation was with that momentum coming in, the price will just continue melting. And this is exactly what have happened. All right. Finally, the last miscellaneous entry models that you could capitalize on, I would advise not to, because they are very difficult to master. You really need to understand the structure, the narration of the market, what the market intent is. From a higher time frame now, we're looking at daily 4 hour and even 1 hour. But these are entry models that I will never advise a beginner to take. If you have had some experience in the market, candlestick formation pretty good, solid, then maybe you can dabble into this, but otherwise stay clear. Now, the first one, very simple. There was equals, right? Liquidation. But I did not enter at the liquidation candle because I was hoping that this zone will be mitigated. So what I'm trying to say is that sometimes price does not mitigate the zone. It just filled in this fair value gap, if you will. It does not mitigate the zone. For me, if there was no mitigation in the zone, I would have not entered the trade. There was a strong reaction though. Ideally, if this reaction happened after it touched this zone, I would be all over this trade. There was no strong reaction. There was only liquidation with a reaction. You can take this trade when you have evidence that there's clear trend here, there's a clear pullback and a clear trend. Everything is aligning properly, you can, but it would be a riskier trade. In this case, the same thing. It's exactly the same trade, but gives you a little bit more confirmation, right? So yes, it created this, but you're still not convinced. Maybe you're thinking that price will tag you in, come back, liquidate this, because this low now would have broken this high. So this was definitely a strong liquidation, touch this, and then we could have entered for a very solid entry. But in this case, what happened was price went up, giving a fresh demand zone. And then when price came back, it gave me a reaction. And from that reaction at the top of the wick, which would also be the order flow change, that's where I put a stop order, because I would want, as soon as the breakout happens, the order flow change would have happened. I wanted to take that train up. This is the trade that I entered. This is the trade that I avoided. And this is the trade I will completely avoid. This would be your equal highs coming in, going back, coming down, equal highs, taking liquidity, entering on the liquidation of the candle. Number of things I would ask myself. Visually, this is equal high, but what if the price was slightly lower than this, right? So the fact that it goes equal high happens. How often that happens, subjective. Will you be able to spot that? Subjective. Did it mitigate any solid demand zone or supply zone on the left? No. Do you want to enter? No. I would have entered ideally after this happened on the breakout of this candle, keeping my stop loss higher. So my stop loss would have gone higher, bigger, hoping that the price would go down. I'm not sure exactly what happened after this trade. More likely than not, it was a break-even trade. But again, there was no mitigation of a good zone. There was liquidation. There was a reaction, but there was no mitigation. Will I take this trade? The price action is messy. The trend is there, but the pullback is messy. I would not have taken this trade. So now you guys know all my entry models, and I've shown real life examples on what they look like in real charts. Now I wanted to give you an example of building the narrative together, having both a 15-minute chart and a 1 minute side by side and telling the narrative of what exactly is going on, right? So on the right is my 15-minute chart, and I'm focusing on this large bearish candle to give you an example, even though this bearish candle, the large bearish candle gave me an entry and it was a break-even trade for me. But it was a clear illustration of what I'm looking for, right? What I'm looking for is that it swept this high. So price was in the uptrend, creating lower highs, lower lows, higher lows, higher highs, higher lows, higher highs. And when this momentum came in, it had already taken the high and immediately broke this low, which means that on the lower time frame there was a clear change in trend. So this low was the reason why this high happened. So this was strong low, and this strong low got broken, which means now the market have shifted on the 1 minute time frame on downward trend, on a bearish trend from a bullish trend. Yes, and this is evident by just that one 15-minute candle. All that entire trend is being built into it. So now when this candle was printing and this candlesticks on 1 minute were printing, it gave us a very nice supply zone. Price moved out, came back in, gave me a liquidation. It did not give me a mitigation. The next candle gave me a mitigation, and I entered on the stop of that reaction candle because the liquidation candle never gave me a mitigation. So once that happened, price immediately started melting. But in this case, look at the range of this candle. How big is it compared to rest of the candles? So once you have ranges like this and you have a box this big, I typically don't take the trade unless it is a very clear money setup, my A plus setup, which is why I took this. Because with such a large trend, typically price will go back, stop you out, break you even to something higher probability, like this is a nice supply zone over here, and this could be the liquidation. That could have happened, right? But if it was a candle which was in the range of this bullish candle, or maybe even you had another bullish candle printed and then you had a strong bearish close on the next 15-minute candle, that would have been a high probability candle. But this is too big of a range for me personally. So what I mean by this is, look at this. So this is the Asian high. Price went up and immediately closed bearish. I am 100% interested in this. So I drew my red box. I was trying to get a trade involved in here. I got a trade. So if you see this, this is a screenshot, so I can't really show you the actual charts. But believe you me that I took a trade here. The next thing what happened, it had a nice bearish close. The low of this previous candle was broken. The trend is there. I highlight that red box, wait for the wick to happen, gave me an entry in this, and I took that entry. Look at that. Now, if I were to show you just this portion zoomed out that I took an entry halfway through printing of the second 15-minute candle, it'll look nuts to you. But if you look at the lower time frame with the narrative building of this 15-minute that the trend has established, why can I not catch it on the 1 minute time frame, anticipating that the next candle will go down and down and down and down and down and down? My trade plan calls out that I don't shoot for the moons, just 2 hours, 3 hours, maximum 4 hours per that candle. maybe takes 2 candles to print it, but this candle got done and I entered here 15:30. I got done in 45 minutes. The next trade happened. I was not interested in, so I was interested in this candle, but it gave me no entry because of this inside bar. The next candle printed, it broke the lows of both and had a body closure. I marked that out. And then as the wick was created on the next one, on the lower time frame, this was the zone that I was interested in. It mitigated that zone. I'm not sure if it gave me a liquidation or not, gave me a reaction. I entered on that candle. This trade, I was literally in for minutes. So what I'm saying is, if the trend is established, if you can see this happening, why not take advantage of these 15-minute candles after they print and anticipate the next candle to go bullish? Look at this candle. This was a big candle, right? I marked my red zone. I trade until the market tells me that the trend is shifting, right? So this was marked. And then I looked at lower time frame to see if I got the opportunity. So this wick was a trend moving upwards on the 1 minute, right? It came into some level of POI that I was interested in. It gave me an entry and I took, look at that entry. It's right at the top of the creation. It's not even at the breakout. I capitalized that with a few pips and looked at my return. Now, if a trend is playing out and I let this run, I let this run, I let this run, I'm looking at over 100 hours in just this one move. Now, do I advise you do that? No, that is just a theoretical number that may or may never happen because of obviously of our emotions coming in and seeing that many hours coming in, closing early and making mistakes, whatever have you. I would never advise you to hold that trade that much, but you can partial close and let the rest run. You can trail your stop loss. You can do all sorts of stuff. Now, after this wick rejection, am I interested in following this trend? No, because now this wick tells me that it is a clear upward trend being established. But wait, when this candle printed, the low of this broke, yes? And what that tells me now is maybe there is an opportunity within this 15-minute candle. Ideally, I would have wanted the low wick of this candle be closed by the body of this bearish candle, but it still did break the low. And we are so much further down into the trend. What is the probability that it can go against you? Now, the probabilities are going against you because majority of the trend has already happened. Now it's time for the pullback phase to happen, right? So the trend, pullback, trend, pullback, trend, right? So the pullback could have started from here easily. But I was interested in seeing or getting an idea that until the market doesn't tell me, I'll keep going. And there was a very nice entry that happened right at the top part of this wick. Even though when the candle was printing, I had no clue this would be an inside bar. But it gave me a reaction. I took an entry. It became an inside bar. And the opening of the next 15-minute candle, because of all that momentum, it gave me my target. So essentially, even though you're much lower in the day and you're much lower in the trend and majority of the trend has already happened, you are not looking for another massive move like this to happen to capitalize your entry. All I am anticipating is just the next candle go in the direction that I want. And that is what I want to. So just this movement is what I wanted to capitalize. Yeah. And then obviously it had a pullback. Now, imagine if I was doing a medium time frame order block or a medium time frame SMC and then going into the lower time frame execution. I would have had a nice order block here maybe, right? So there was a buy to sell. You could have used that entire range over here. You could have had some order block over here. Nothing in this, right? So majority of the buy to sell wicks, these guys ignore. But imagine nothing here, all entire session you missed. Now you're waiting for price to pull back into your POI over here, this entire POI, and you could or could not get an entry. If you did not get an entry, you would have missed this entire move. You missed already this entire move. You missed all the trades within this. You could have capitalized and made over 150 R just following these trends and following the candles. And if you really think about this, it is not magic that this is happening. There is logic and reasoning behind the entries. What the SMT guys or the higher time frame or medium time frame order block guys will tell you is a price goes into this high probability POI and then you go into lower time frames for an entry. I am telling you that there is already a POI within that 1 minute trend established already. And if it is a trending market, why am I not taking advantage of that trend, hoping that the next candle will also be bearish? That is the whole point. Instead of me wasting my entire time waiting for the next perfect POI to hit and may or may not give me an entry, I have 3 hours to trade from. That's 12 15-minute candles. I have 12 opportunities to capitalize within one session. And I am not interested in wasting my session going into a POI that might happen in New York when I'm available on the candles or not. I focus in one session. I look at the entries that happen. If a good setup happens, I take an entry, and then within the next 15-minute candle, hopefully it reaches my target. And then we have another candle printed. I mark that candle and see if that trend continues. If there is a pullback into a good POI and an entry happens, I take another trade, right? This is how day trading is done. This is how there is logic behind it. There is reasoning behind it. It's not me jumping on one leg and then telling you that if you jump on this leg at 9 a.m. or 10 a.m. at London Open, and then you see this candle and wait for the breakout and then take the trade while jumping. Yes, you can show me hundreds of times where this has worked, but I can show you thousands of times more that this hasn't worked. And the whole premise is I am not interested in 100 trades. I am interested in 10,000, 100,000 trades over the course of many decades to come, that I can keep repeatedly doing this, because the market trends, right? And a trend is established when 15 minutes move, and within that 15 minute, you can very easily visualize the 1 minute trend. And if that 1 minute trend is happening, capitalize on it for the next 15 minutes to go in your direction. All right, guys, so that was it. After this, I'm going to show you full charts of trades that I've taken, and let's go from there. See you in the next session. So now I want to show you screenshots of all the trades that I've taken. I won't go through all of them, but I'll try to go over as many as I can to give you some confidence on how you can play this out on a daily basis, at least 12 opportunities per session, right? So let's, I'm looking at yesterday, I say, April 10th, and I was looking at this bullish candle here. So this bullish candle here closed strong. It broke this high. So I want to see if I can get a trade within this. Obviously, I have no idea what's going to happen, if it's the next one is going to be inside bar or not. But as this trend was picking up, there was a pullback, there was strong liquidation, it kept pulling back, there was another strong liquidation, I entered on the liquidation and it gave me my target that I wanted. Let's move on. This one right here, the arrow is here. So what a strong, solid momentum coming in, right? What a strong, solid candle close, range higher than all of these consolidation candle ranges. So there's definitely clear pressure that the price is now moving in the upward direction. Clear trend over here. Price pulled down, price pulled back up. This low broke the high, came back down. This was the only zone that I saw that was valid. We had a strong liquidation. I placed my entry at the breakout of that candle, and it was this trade was 3-4 hour already. Okay, let's move on, and I'll show you losers as well. This is the candle that I'm interested in. We had a solid, strong candle. It had a strong, solid close. It broke this high. It broke this high. So there is definitely trend in the upward direction. When I printed this red dot, this is red dot, I said, red box. This is the box that I'm focusing on for price action. I'm not focusing anywhere else. So I'm looking at it and I'm looking, price is trending downwards. Okay, fine. Now the price is going upward. Okay. And then it came down as the new wick is being created. and after that, it gave a strong reaction. Now, this is a mistake that I did, and this is how we learn, right? What did it mitigate on the side? All it did was fill in a fair value gap, but there was no mitigation in active zone. I like to trade from actual zones and not just the filling of the fair value gaps, but there is no mitigation to the actual zone. It gave me a reaction which created these order flow changes, which is why I entered thinking that the larger time frame, the medium time frame, is building a narrative that the price is going to keep pulling and pulling. Maybe the third candle will be bullish, and it could be. The odds were stacked in my favor. But one mistake I made, just focus on this red box. What do you notice? Do you see a trend in it? And this is the mistake I made. I was following this as well, and I'm like, okay, fine, there is a trend going upwards, then it's coming down into a nice zone over here, then it pushed back up, so this is a nice zone. If price had come down over here, yes, the entire story makes sense, and you could have pushed up. It did push up to this point, so if I had an entry at here, maybe I would have met my target, right? So my target is just limited to 115 or the second 15-minute candle. I'm not looking for the entire session. It would have given me my target to 3-hour max. But looking within this box itself, it's garbage, it's consolidation. There's no trend. This reaction was from nowhere. There was no mitigation. Once no mitigation, I should not have entered. This strong close threw me off, but then price tanked. So this was a loss. Look, compared to this, look at that strong trend, right? This is what I'm talking about. With liquidation and a mitigation of a zone with a reaction, this is what I'm talking about. So let's look at this. Compared to this, no trend. Compared to this, you have a trend. Yes, not only you have a trend, but price actually created from this bullish trend downwards on a 1 minute time frame swing side of things. It did broke this strong high, which created the entire trend to be bullish now. So price moves within the first 15-minute candle, goes back, immediately breaks the high, creates and gives me the zone, comes back in, and then gives me a reaction. So I entered from a reaction. The reaction was what? That it took the low and then it strong bullish cross. So there was a lot of price coming in, push from the buyers coming in, gave me this larger wick with a body closure. At this point, I'm anticipating that this momentum to continue. It does, and it gives me my target. Yeah, this is this 15-minute candle over here. So why did I choose this 15-minute candle or this candle? This is the candle that I was looking to trade in. It was a strong candle with a strong body close. It broke the high of this wick, which created an OFC. So this wick breaking is basically this high over here, which got broken by this. So from if you look at this point, I draw a horizontal, and this right here has the body and the top wick of this bullish candle. So there was a clear shift in trend. All I'm anticipating is that the pullback to happen. So this is the pullback that happened, and price gave me a reaction going into the zone. I took it, and it did give me a nice trade, and I made my target. Let's look at this one. Again, it was not a strong body close, but the price was in upward direction. What happened? This is the box. So this is the candle I'm catching while it's printing. I had no idea that it'll be this big of a candle. All I'm doing is I'm just marking this candle that has already printed and putting a red box around it, because now I'm focusing on the price action over here. Price is trending upwards. You can see the high was broken, so the swing trend is also upwards, so the price is going upwards. Price came down. It took liquidity, but it gave me no entry at this liquidation, and moreover, this is still part of the previous 15-minute candle, right? So next what happens is that price comes into this zone over here, this sell to buy zone, which is what I will take. Was already mitigated. It comes into there, touches, goes up, gives me a strong reaction, and then I enter the breakout of that trade, looking at that the price is still moving upwards. It wasn't a huge move that I wanted. I just wanted a slight move and to give me my target. You could have, after this reaction, come in, placed your trade at the breakout of this reaction and a stop loss at the low, a strong protected low. That would have been a good trade as well. So both of them were winners because of the momentum just kicking in. And I could go on and on and on and on and on, guys, like this trade. Clearly took the low, closed up high pretty aggressively, took the low, closed up high pretty aggressively. The next candle, so the same candle pulls down all the way into a nice valid demand zone. There was no liquidity. So this is EM2, where I was telling you sometimes there is just strong pushes and pullbacks. There is no liquidity. This is where the second 15 minutes started printing low, low, low. This is the wick creation into the body. Comes down here to a valid zone, gives me a solid reactions. Once I see these highs starting to break, I enter at the breakout. Bang, nice entry. And the price goes in. This is another one. I had no clue that this would be a bearish close. This candle was printing. I saw this candle close, broke the previous highs. There was an inside bar, broke the previous high. I am now marked this candle, anticipating that the next candle will be bullish, which evidently, in hindsight, now was not. But my gut feel was that it would go in the direction of the trend unless the market gives me evidence that it's going to stop trending. So I mark out that area. That is my zone. Price got liquidated. Price came in to a nice zone. After the liquidation, I placed my entry at the breakout. That wick and the pin bar or shooting star tells me that the price is now ready to move in the up direction. And all I needed was that one push to reach my target. I did not even break the range of the previous candle, leave alone missing all of that upwards. This could have been an easy 10-hour, 8-hour trade, but I'm happy with my 3-4 hours. Why not? And it continues. So guys, just to wrap everything up, all I'm trying to tell you is that market will give you ample opportunities every session to take advantage of. Now, not every 15-minute candle is for you to trade, that you have to trade every 15 minutes. No. You pick and choose between the 12 opportunities in the 3-hour window. Consider them as 12 bullets, right? You have 12 bullets and you have to pass this challenge level 1 in a game, and you have to use your bullets wisely. So once those nice targets set up, start looking for your entry model. Put that box around it to help you focus on that price, 1 minute price within that box only and nowhere else. See if there is a liquidation. See if it's reacting from a valid supply and demand zone. If it is, take that chance, shoot that bullet, and hoping that you will get the bullseye and that target will continue in your direction. The fact that all of these confluences are stacked in your favor gives you the edge in the market over a long time, that you will be very, very consistent, very, very profitable. And then you will also save your mental health in the process. All right, guys, if you liked my content or if you did not like it at all and completely disagree with it, by all means, you have the right to. But do share me your thoughts in the comment section, like and subscribe, and share this. Save this video. It is a pretty long one. To come back, revisit, and ask me any questions if I was not clear enough. Cheers, everybody. Bye-bye.